Welcome to Geared for Growth. I'm Mike Mortlock, and today we're catching up with a returning guest, property investor, buyer's agent, and all-round straight shooter, Tim Brown. Now, Tim's been on before, but this time we're pulling back the curtain on a decision most investors struggle with: selling a property, or in Tim's case, 3 of them. This isn't just a story about transactions. It's about ego, strategy, and growth. When Tim hit the wall with borrowing capacity, he faced the uncomfortable truth. The only way to go forward was to let go. And in doing so, he cracked open a bigger conversation about performance-based investing, trust structures, serviceability ceilings, and the modern realities of Australian property markets. If you've ever asked yourself, should I hold or should I sell, or wondered how to tactically restructure your portfolio for long-term growth, this is an episode you'll want to lean into. Let's jump into it with Tim Brown. Tim Brown, thanks for joining me back on Geared for Growth.
Hey, Mike, thanks for having me on.
It's not the first time you've been on, of course, but it has been a little while since we've caught up with you. And I saw something on one of your socials that made me think, gosh, that's a perfect episode and a really interesting time in your own portfolio, I suppose, development as well. And that was a little video about you talking about selling a property. Now, it wasn't just a transaction. There was a lot more to it. There was some ego swallowing, there was some strategy, and probably quite a lot of sort of painful reflection to get to the point where it's like, it is actually the best decision to dispose of something, even though we're always kind of told, don't get in and out in property because it's too costly. So thank you for being a willing victim to share some of that and let me pour some salt in that potential wound. But talk to me about that video and what inspired you to share that.
Totally. So, as you know, I'm pretty open and honest on my Instagram, and I share quite a lot on there. So I thought I would share what I'm doing currently, not just what my clients are doing, not just the sort of free value I'm trying to give. So I shared that I actually have sold 3 properties in the last month or 2. And the reason that was because I want to continue to grow my portfolio, and I expanded my portfolio to 7 properties, multimillion-dollar portfolio. However, I was out of servicing. I was stuck. The bank said no more. And then there was an ego barrier of how do I restructure? How do I change the strategy? How do I progress this without compromising my ego? So my growth, sorry. I had to remove the ego. So I had to sell some properties to go again, to restructure, to rebuild my portfolio. And that's what I was sharing. Hey, I'm selling 3 properties. Sometimes you have to do this, and it's the way it goes if you want to expand.
So, of course, you wouldn't have hit your head up against the ceiling with one bank and thought, okay, well, I've got to sell stuff. I'm sure you investigated, okay, well, what options do we have? Are there other banks? Are there second-tier lenders? How hard did you sort of fight to say, no, I don't want to sell these properties. I just want to get the next one?
Yeah, it was a bit of an iteration. So it took a while. It did take a while. One, it was sort of on the back foot or the back burner for a little bit as I focused on my business. And then I got to a stage where I thought, why aren't I focusing on my own portfolio as well? And I had already tapped out of my servicing maybe maybe 2 to 3 years ago. Mm-hmm. And I was just letting the portfolio incubate. But then I was buying for my clients in these awesome markets thinking, God, I wish I could buy this deal myself. And then I thought, what am I doing? Why am I not buying for myself? So I got to re-understand how to grow the portfolio. So I guess my key thing was working with the best people. And this is something I preach to my clients as well. Like if you want the right team around you, you need to have the people who understand what they're doing. And speaking to some really gun brokers, and particularly one gun broker, he said, mate, if you want to expand, you got to ditch these, because it's not about taking back the capital from the growth you've had. It's actually more about getting the debt back, because the debt is then the asset or the tool that you use to go deploy into markets that then let it grow. Yeah. So that was a mind shift change for me. And I understood that, okay, I need the debt back to then restructure how I buy my portfolio, meaning I went into more sophisticated entities like trust structures. Yeah. And then I'm now going out to buy 3 more deals. Yep. Okay, so it's more of an understanding of how do I aggressively grow my portfolio, and it was removing the ego to have to sell properties to get the debt back to change how I was doing it to then go again. And yes, that's a pain in the ass. Yes, it's a lot of paperwork. Yes, it means a lot of tax implications too. But the understanding of the better off overall, the better off over the long term, if you can get that clear, it makes so much more sense than to be ego driven to hold on to a few deals you bought a few years ago.
Yeah. So the three properties that you singled out of the, what was it, 7, what was fundamentally, I don't want to say wrong, but we'll use that as a placeholder. What was fundamentally wrong with those 3 that perhaps the 4 didn't have wrong with them? Or maybe there was one that was close and it could have been either one that you sold, but why did you sort of lean? Like, explain to us what was fundamentally incorrect, or was it actually just amassing so much in the personal name that it was better to not replace those 3 with different types of properties, but buy them in a different entity?
Yeah, so there's actually a lot in the answer to that. So originally, the properties I could buy and afford whilst I was in the army on a restricted wage were lower quality. So they had quite a few townhouses and units as well. All right. So when I'm talking about scaling the portfolio, a part of this was upgrading the quality of the dwelling I had into a piece of land with a house in a location that has a data set to grow. So that was also part of that story. The second part of that was about the entity I was buying in. I was maxed out my personal name. So then the growth had stopped in these regions. So my option was, do I sell, rebuy into a different entity, into trust, to then be in new regions to capture that new growth and then expand it and go beyond that?
And that's something that I wanted to kind of unpack with you. Apart from people that are just hitting their head on the ceiling with serviceability, we are at a time in Australian real estate where I'm seeing, probably for the first time, people actively entering markets with an exit plan that is less than the typical 10, 15, 30 years. For example, I heard some buyers agents talking about, we are going into Perth in 2019 and we're going to be out by 25, 26. And I think that there were probably people targeting markets like Darwin at the moment, or in the last 6 or 12 months, with a similar idea. Now, the conventional wisdom is, it's a bad idea because the cost of buying is high. You've got the stamp duty, which is a one-off payment at the moment. And then, of course, when you sell the property, you've got the capital gains tax. Even with the 50% capital gains tax discount, if it's in your personal name, it's still money that you have to pay for disposing that asset. But I wonder if there are markets that can achieve 50% growth in, say, 2 or 3 years. Is it time for us to consider whether that tenet of investing needs to go in the bin?
Yeah, I really think it is. And I'm seeing the tangible change in that in the strategy from myself and my clients, but also other investors and BAs across the board. And there's 2 reasons for it. One, exactly what you just said. Is there a better way to do this? But 2, it also comes down to the personal journey of that individual client or investor as well. Some people are totally fine just to buy, set and forget, let the compounding interest do the work, and they're happy like that. It's a bit easier, it's a bit hands off, and that strategy usually always works. It's more the people who go, I need to get an aggressive growth. I want to be more tactical and develop a strategy that actually can get me to where I want to go a lot quicker. And then that's when you start finding that timing the markets. Now, that has always been, it's not timing the market, it's time in the market. And now I've said that many times myself, and I've changed my tune now, because now the data that is available and the information that we can get so quickly like that with the systems and the internet these days, it's now something that actually is achievable, in my opinion. Back in the day when the investors were sort of going off local area knowledge, magazines, it was a bit slower for these things to change and to happen and to understand the markets. Whereas now you can just jump online and understand a market like that. Not intricately, but the base understanding. So it is giving people and affording people the option to be more aggressive, to push into this market tactically, to pull out of that market, pay the dues to the government and move into another market and expand that. Maybe they've bought 2 now. So that has been a huge strategy I've adopted, and a change in the way I'm delivering my service to my clients too.
That's a very, very interesting one to observe. And I suppose we've covered off two key reasons why you would sell a property. One, you've tactically done the modeling and you know that even though it's going to cost me to sell the thing, I've got CGT, this is the sort of market that it's actually better to go in, take those gains and then move on. The other one is hitting your head on the serviceability and the banks won't play with you anymore. The other one that you kind of touched on that I want to call the third one is you're talking about you bought some properties that you termed sort of lower quality, or at least it was at a time where you had a lower income. So your borrowing capacity wasn't massive. So you had to compromise on the quality of asset. Now, had you got to the situation where, let's say, your serviceability wasn't a problem, would you or should you have considered selling those properties to upgrade into better quality assets anyway if they haven't been performing? I kind of want to know the question, like if there's a property investor listening that's got a couple of properties and one has had some results in the past but has been flat for a long time, at what point do we start to question whether that property still belongs in our portfolio?
Yeah, it's a great one. And I think that regardless of the property type, if it's not performing, that is where you do need to consider, is that right for my portfolio? Is it inhibiting my growth or my goals? It might not be. It might just be a part of that market cycle and you might be having a long term play with that property. But if it is underperforming and you're missing out on other markets that are performing, that's where it becomes a key decision, in my opinion, because it's the change in mindset of abundance and growth from loss aversion. So if you're missing opportunities of other areas that are producing better growth, better yields, better properties, better opportunities, then that's what you're weighing up against, not just how much is it costing you or what's the quality like. The quality does matter as well, but it's about getting into the right market for the right quality. So the opportunity cost is what you need to be analyzing, which is really hard because you're sort of making it up. But for me, in my position where I'm informed on investing in locations, stuff like that, I can see it really clearly. And that's where I can help myself and my clients navigate and understand the opportunity cost to get rid of those underperforming properties and transfer them into better ones.
Mm. So it must have been interesting to sit there and look at the 7 properties and go, all right, it's time to go you 3, and some sort of Survivor, there goes your flame turned out. I don't watch the shows, but I think it's something like that.
That's right.
So when you did that, what was it that you identified in those that you kind of thought, these are the ones I'm most happy to get rid of? And I chose that sort of expression carefully because I'm guessing there was some sort of sadness, because we're always kind of thinking we need to grow, but for that moment you actually needed to contract.
Yeah, totally. It's the contraction to then go even further beyond, but you got to be able to see the further beyond. Otherwise, it does, have a negative impact on your mindset on it all, because you do feel like you're going backwards. And again, that's the ego part that you got to navigate. So the properties that I got rid of, they're essentially the main concern was for me, how much debt can then I go re and lend? So by selling, which one equals the most amount of debt for me for me to go to use again. Okay. So it wasn't necessarily just the properties. However, once I had figured that out, the next layer of, I guess, assessment was which one is costing me the most, because that also plays into serviceability. I had a couple that were cash flow positive and they were low maintenance. So those are ones that I probably don't need to touch at the moment. If there's ones that are constant problems and there's maybe major maintenance that is coming up, maybe re-stumping or whatever it might need to be, bathroom renovation, if I can get rid of this property now and avoid that cost as well, then that's going to add to the benefit of ridding that property. So to answer your questions more specifically, what's it costing you? Which ones are costing you the most, where the growth is now potentially being completed? Yep. And then which one is going to give you the most debt back or serviceability to then go and create the most opportunity in another market?
Yeah, that's an interesting one, because I guess you might have one that's got, say, a bigger mortgage than another one, or the loan to value ratio is much higher. But if it's a cash flow positive one, or it's negative, but when you compare it to another negative one that is in an area that's just requires more maintenance, or has higher council rates because it's in a cyclone zone, or higher insurance because it's exposed to 1 in 100 year floods, like it's really more about what it means to the bank that's assessing whether you can go again, right? Like that's the most important thing.
Totally. And this is why having a gun broker is so important, because they're the ones informing you on the tactical decision of which one makes sense. So it's not just up to me and what I think. It needs to be working with your broker. What if we sell this one? It's all about wargaming it.
Yep.
If this one goes, what does it look like here? Okay, what if we keep that one, we ditch those two? This is what it looks like. Because again, going back to the opportunity of what markets do I need to access that are going well or soon to grow for me, where I'll get the most gain, that makes these decisions make sense. So that's where you need to figure out and assess all your options, which is basically just a whole bunch of numbers that you're running. Like if this one goes, if this one goes, if this one goes, to equal the opportunity that you can go and get. So a broker is absolutely key. I wouldn't be doing this just by yourself or just off gut feeling. Again, it comes back to those professionals who can help you.
Yeah, absolutely. So talk us through what actually happened. You had the whole portfolio in a personal name, is that right? And then you that led you to establishing a trust, and that was the vehicle for the next acquisitions with that extra kind of borrowing power?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Totally. So I'd maxed out my personal name, mine and my wife's. We were 7 properties deep, all personal names. So that was one of my earlier mistakes, which I've also talked about on my Instagram as well. Like, here's my mistake. I got stuck. And it cost me not much, but it cost me the opportunity of what I could be doing or could have grown to now. So that was the key decision of understanding I can't grow anymore. What do I need to do from here?
Yep. And so with the acquisitions in the new entity, have you done those yet, or are you shopping, or where are you up to?
I'm currently shopping. I have the new entities set up. I'm ready to go. I've got about 1.85 million to spend at the moment, and I'll probably buy 3 deals based on that in the current areas that I'm investing for, exactly where we're buying for my clients. So there'll be 3 deals pretty in quick succession, all under trust structures, which will capture my lending ability at this moment. They're a pain in the bum. They cost you more money, but it's worth it to then have the ability to not get stuck as quicker. It's not unlimited lending like some people think, but it allows you to be able to go that few more steps further than what you would do in your personal name, particularly when you have rate hikes that we had during COVID when people were losing jobs and stuff like that. We lost our serviceability.
Yep.
So it's trying to avoid those things.
Now that we're playing the new serviceability game within the trust, are there things that you've learned throughout this process to say, okay, well, I've got X amount to spend. I'm looking at 3 properties, but they've got to match a certain criteria in terms of their net cash flow position or their land to building ratio? Like what is it that you're looking at that's kind of making you think this will help me hack the game of finance that property often becomes when you're a multi-property owner?
Yeah, that is certainly one to navigate that's quite difficult at the moment, because technically within the trust entities, the company or the entity needs to be trading profitably or at least taking care of itself.
Yep.
With the interest rates at the moment, not that they're crazy high, but it makes it very hard based on the purchase prices to have anything net positive or what the trust would need. So there's tactical ways around that, and it does play into what are we buying. And that's where I like sometimes the regional areas where they provide better yields. So you're getting closer to those marks where you can actually then have the structuring work for you. So, for instance, we love Melbourne and Victoria at the moment. Like, I know most people are talking about that. But buying Melbourne inside the sort of metro urban area, the yields are horrible. So to buy 3 properties like that, you would just be bleeding cash and it wouldn't work and it wouldn't stack up in the trust structure. So not that we're saying regional's cash flow positive, but there where we're seeing one better opportunity for growth for that price range and also to manage buying within those entities.
Yep. Yeah, that makes sense. I think the print yesterday was Melbourne's running at a 3.9%
Mm.
yield, which when you consider the interest rates and a little bit of deductions and maintenance and those sorts of things, cash flow positive is not possible. So when you're trying to acquire these properties in a trust with more of a cash flow positive net position, are you inserting cash by business dividends or personal, or are you actually just going, okay, well, maybe we need to have a lower LVR to make this more positive? How do you tactically tackle that?
Yeah, a little bit of both. The LVRs were going in at 20%. So there's still more work to be done in terms of having the trust operate by itself. And this is where having a good accountant can help to manage how you're going to structure that as well. Well, obviously they set it up, but how you're going to have funds in certain places to look after the property. So utilizing surplus capital to help structure those properties, that's probably what my move is at the moment. Yep. If I need to, obviously we can put those cash into offset accounts or redraws as well to help that. But I typically don't like to put extra into the deal in terms of the deposit percentage, more than 20% if I don't have to. Even if I utilize different offsets and redraws, I'd rather control my liquidity than give it over to the bank completely.
Yeah, that makes perfect sense. I don't think there's any bank fans that listen to this show. It's always give me what I want, and if you won't, I'm going to go somewhere else that can help me. So in terms of the next sort of steps for people that maybe have, let's say, 2 or 3 properties or more, and they've owned them for a couple of years, and they're sort of thinking, gosh, I don't know if I want to hold this thing for 10 or 15 or 20 more years. At what point should people be analyzing that property to see if it's a fit? You preface something earlier in the episode where you sort of said, like, some of the properties that you purchased, they're not delivering growth anymore. You might have purchased them on the upside and they've had their upswing, but they're a market that kind of has a bit of a feast and famine and a big gap between. Is that where people should be looking at it, or is it more in consultation with a broker to say, this is what I've got? If you had to point at one of these that's holding me back, are any of them, or are all of them maybe?
Yeah, it's interesting because you don't want to get caught up with selling properties just because you're addicted to the buying. It's got to actually make sense. Like, is that location done for you? Has it performed? Has that property and location performed for you how it was supposed to, based on what you're trying to do? So selling prematurity might also be a mistake if there's the data and the metrics and the evidence is stacking up for that property to continue to perform. Then I wouldn't be selling it just to jump into another market, because there are costs to sell, and the ingoing and outgoing costs, they're part of the process, but you don't want to just delve into it just because it feels cool to continually, I bought 5 properties this year. Awesome. But like, what is your strategy? So I think the balance between that is really key. Is this property performing? Is it going to continue to perform? Is there an opportunity cost in another market? If there isn't, then just chill out. I think I would only ever sell or advise someone to sell if they're going straight back into another deal. Because as much as we want to be tactical in the markets we're in, still holding the properties makes sense.
Yeah, absolutely. That is a good point, because if you're waiting 12, 24 months, then it's not just the capital that you're employed, it's that leveraged ownership of that particular asset. And if you're out of a market that you've been looking at for 12, 24 months, I mean, there could be a reasonable uptick in that market. And with that leverage effect, you could cost yourself a couple of $100,000 by inaction, right?
Totally. And you will see that happen probably, to go on your example before, in Perth, where people see, oh wow, it's done this much in the last few years, I'm going to pull out now. But, people were saying that maybe a year or 2 ago. Perth is still humming along, right? So that's a prime example. Are you too ambitious in recycling your borrowing and selling that property? So really understanding that. Now, it doesn't mean that you have a crystal ball and you're going to be able to time it appropriately, but to harp on again, it's more about, is there better opportunity elsewhere? That needs to be really considered in the conversation, because if it's not, and you're just selling for no reason or whatnot, then it doesn't really make sense. It's not very tactical. It's just a decision you're making.
Absolutely. And I don't think anyone should be addicted to the buying process itself. It's more of the sitting and watching process that makes you the money, right?
100%. And that's the funny part about it all. It's the boring part that actually gets you the gains. It's the annoying, frustrating planning, strategizing, and purchasing process that is not the moneymaker. That's where you feel the broke, essentially. I was actually having a conversation with somebody yesterday about this, and the perception of non-property investors is, oh, you got all these properties, you're rich and you can do this. It's like, speak to most property investors who are sort of early to mid in their cycle, they're stringing every cent together to try and hold that thing together because it sucks, it's hard. And yes, probably this is going to get smashed up. Well, property investors says it's hard. It is, because you're giving up and you're compromising the cash that you could be enjoying right now, the capital and the opportunity for the potential of bigger growth later on. And that costs money. So if you have a lot of properties, it's usually costing you a lot of money to start, but over time is where you see the gains. It's that compromise that you make early on.
You make a good point. I can see the headline already, like property investor with 7 properties, sad and hard to be him.
You said, stop complaining.
But you're absolutely right. I mean, for your average person that builds a portfolio like yourself, there is quite a lot of pleasure delaying. There's quite a lot of choking your finances down onto the 2-minute noodles, or putting things off, not having the nice car or the holidays. There's this. I saw one particular comment on a BA ad this morning, and it was like, how to, achieve the success like this guy. And there's one, like, have a rich grandfather. 2, have a rich dad. I'm like, well, that's actually not the reality, I think, of anyone that I've interviewed on this show that's had success in investing property. Some of them have come from backgrounds where they were paid a reasonable amount of money, maybe $300,000 or $400,000. So yes, it's easier for them, but still, there's lots of people on $300,000 or $400,000 that if they lost their job, they would be in big trouble because they haven't employed that capital in a sensible way.
Mike, you're preaching to the choir. This is what I love talking about as well, because it's so true. You see what success is out there, especially on online social media. All these people, and I speak to a lot of them, earning stupid amounts of money per year, but their net wealth is nothing. Their net wealth is personal debt, card debt, credit card debt to keep up with the Joneses. And then I have investors, or speak to other investors who are on, 70 grand a year, or maybe a combined couple of 150 to 200 a year. And they've got 7-figure portfolios. No, sorry, 6-figure, 7-figure portfolios already. And just, they're better off than those other people, because if they lose their jobs, if they both lost their jobs, that person who's on the less income is way ahead because they have the assets. And worst case scenario, they can liquidate that and sell. And that was where it was reinforced for me during COVID, when my wife lost her job. I was in federal enforcement, so I didn't lose my job, thankfully. But we had the properties there. So worst case scenario, if we were people who lost both our jobs, we could just sell the properties and then at least have cushion, at least have comfort.
Yep.
So I think that's such a misunderstood, I guess, the look of success. People misunderstand what success really is. It's about having those assets behind you for not just emergencies, but for future growth.
Yeah, and I learnt actually something from a guy I've had on the show recently, our resident behavioural economist, Evan, and there was some research into what are the markers that are most likely to lead to bankruptcy, and that what they actually found was that living next door to a lotto winner was the biggest indicator of bankruptcy, because this person has now got this money that is maybe invisible to the person next door, and they have a nice car, and the next door neighbors try and keep up. But without the lotto win, it's impossible, right? Isn't that an interesting insight?
That's so interesting. That goes into human behavior, isn't it? And then again, we could strip this right back down to ego.
Yeah.
It's I want to look cool. It's a status symbol and stuff. And it's psychologically hard to get over that, particularly when you're not aware of it. And most people aren't aware of it. They're sort of just living this, the whole saying, keeping up with the Joneses. So awareness is one, and then actually being comfortable in yourself to buck that trend and go against it, that's when we find the real successful people. And they're the ones that you're talking about who you interview.
Yeah, absolutely. And loss aversion is another thing that you mentioned that feeds into behavioral economics. We do actually fear the pain of the loss more than we recognize the potential upside in just crystallizing that loss, which is obviously what you've done. So to finish off the show, I wonder if there are some key takeaways that going through this process yourself, you could kind of disseminate for the listeners into a little soundbite.
Totally. Okay, so I'll put it like this. The bigger picture is more important than the micro pain you're having. So understanding that that your trajectory, if it's the right trajectory and you want to get somewhere with your wealth building, then the micro pain you're going through is the barrier that you have to go through to get there. That is the pay to play game. And I talked about that with my clients. You need to pay to play. That means your air cons will break. That means that you have to pay the bank. That means you have to pay tax. But that's the game you need to play to get to the place where you want to be. If you don't pay, you won't play.
I love that, mate. You've over-delivered on the requirements for that. Thank you very much for sharing all of those painful moments and the trajectory and the learnings that you've had to get through there. You've been very, very generous, and thanks for coming back on the show.
No worries. Happy to come on any time, and thanks for having me, Mike.
Cheers.